welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook and your host for the next 25 minutes here on Options Guide TV. All right, so here's what we got. Cisco is at one. Cisco is at 123.75. It's up $2.35 on the day, or 1.89%. We have them announcing earnings on Wednesday after the close. I want to get bullish on Cisco heading into that earnings report. I like that they're announcing on Wednesday after the close. Thursday is our ideal for our little butterflies that we like to do, our open wing butterflies. But to try to get bullish on this scenario, we are going to use this Friday expiration date, which it's Friday the 14th, and that's 4 days away. We're going to start by looking at what the long straddle is to get us the expected move. So we have $124 underlying. If we bought the at the money call and bought the at the money put, we're looking at a $10 move. So $10 is a solid move. I implied volatility that actually highlighted to me that implied volatility is pretty high, 95% here on the Cisco scenario. And that puts us at about 134. Now, once again, expected move is just the best way that I have to explain it. I mean, I hate to use gambling terminology, but it just applies so well. And it's the over under on what could happen after that earnings report. So the move is not bullish, it's not bearish. It's just saying that what people are willing to pay for in premiums by buying the at the money call and buying the at the money put gives you a hint to the potential movement of the underlying stock. So people being willing to pay this price implies that this possible move could happen. And in this instance, it's going to be about a $10 move, $10.15. Now, I never ever take it as a exact, because it's not an exact science by any means, but it does help you when you're setting up strategies and you're trying to target a potential range. So in this instance, if it does make that 10 point move, which is within the realm, that is, so 124 plus 10 is 134. We're looking at a 24% chance of the stock finishing about 1 cent in the money. And we just look at that by looking at the delta. So it's not saying that there's a high probability that it's going to move 10 points. It's saying that if you're looking at this and you're going to say, oh, okay, I'm going to just speculate on the potential move. I'm going to buy the long straddle because I think it's going to be more volatile than what the marketplace is saying. Or I'm going to sell the straddle, sell the call, and sell the put to think that it's going to move less, and it's that simple. So, if you were talking in the sports world, you a lot of times you'd say, I don't really have an opinion on the winner of the football game of the NFL football game. I got to clarify that now with the World Cup just recently ending, but with that happen, I don't have an opinion on who might win, but let's just bet on the total. I think that both teams are going to score 45 points. I think they'll score that easily. I'm going to bet the over on that. And that is the terminology, and this is where this comes from. And whenever you hear analysts come out and say that there is I guess in this instance, about a 9% move, Cisco after earnings has the expected move after earnings is about 9%. And when you hear that, that's all they're doing. They're just looking at the long straddle. There's nothing fancy that's behind it. It sounds good when you're, on a financial news radio or something, but it's literally just looking at what the long straddle is. Now, here's one of the biggest misnomers, though, of it is that's until August 14th. So unless there's an expiration the next day, it's really not after earnings. It's really after earnings before the next expiration, because you're looking at this is what they're willing to pay for this long straddle, and it expires on August 14th. All right, so a little bit more on that than I usually do. So let's move forward with it. And with a 95% implied volatility, balls are up, and this butterfly is going to be relatively cheap to put on a $123 stock. Now you can do as many contracts as you like, but we always talk about one contract here on Options Guy TV. Now, if I'm doing this, I'm usually trying to target where I think the stock can at least get to, right? If the expected move is 10 points, let's cut that in half. And that's going to kind of be our starting point, right around the 5 point level. So we'll look at the 129, and that's saying a 36% chance in order for that to happen. And if that's at 129, a 130% chance for that to happen at 33. So well, I guess we'll do 129. Let's do 129, and let's see how cheap we can go. Fairly wide then, because we're going to get so much premium for these out of the money options. Yeah, the balls are staying sticky, so we'll buy this one. We're going to go up to let's try the 134. Let's sell two of these. And this would mean we'd have to get it done for less than $1. 84 cents. This only gives us 24 cents of upside. Maybe we do the 136. We need a little bit more upside if it blows through to the top. $1, and then that's not bad. We can do that. I mean, I told you it'll be a real inexpensive trade. Now, this has everything to do with volatility. This is high volatility for CSCO around earnings, 94% implied vol. And because of that, this is a fairly cheap butterfly to put on. Now, don't go crazy with the leverage. We always, just like I said, we usually talk about one contract here. We could even go a little bit wider. Let me send this one to the what if calculator and get it up to $2, and that would be our risk in the trade. So here's the open wing. We're buying one of the 129, and that's half of the expected move. So very feasible if the earnings announcement is perceived as good, that the stock can at least reach that strike. If it continues on up to 134, this is our sweet spot, right up to 134. At that point in time, the maximum we can make on this trade would be $400. We're risking $1, we could make 400. From that point on up, though, we stop short on our short spread in that we don't go as wide as our long spread. We don't bring in quite as much credit, but that opens up that wing and allows us to be profitable from 136 on up. So the short spread is 2 points wide. The long spread is 5 points wide. That means that we're leaving $3 from this point on up that this butterfly could trade for. If we pay $1 for it, that means we can make $2 for it. And I'm highlighting that with my cursor right now, or $199. So it looks like it came in at like 101 is the price, that the limit price that it came in at. We're going to send it down to the floor at 1, but I'll put 101 in. All right, so real inexpensive trade to do if you want to try to learn about open wing butterflies. Getting it done for a net dollar of $1, $100 for this trade, potential to make as much as $400. If the stock blows through the earnings, we can make as much as $300 on this trade. If the stock goes down, we lose the $1. That simple. Nice risk reward profile for it. CSCO trading for high implied volatility heading into this earnings. They're announcing on a Wednesday. Stuff's got to happen by Friday. That simple. Let's look at making it a little bit more expensive. Let's go down. We're going to go a little bit wider on this. We're still going to target the 134 level. I like being right around where that expected move is at as my pivot point, as this is the spot where we hit the home run if it went out at an expiration. That is our what I call in my book, actually, the sweet spot, which is also the name of my boat. We're going to move down to 126 and go up to 134. So now we're talking uh, 8 points. And we go 4 points here. And let's go, yeah, let's go 4. 138. Yeah, 183. That's still not bad at all. Send that to the what if calculator. So we almost doubled up the price. We become profitable at 126, so a lot earlier. We have way more upside, $616 on the upside. We're paying 183. If we blow through the strike, we can make 217. But we're profitable. We got a long range here too, so we got to go way above the expected move even. I should say the one standard deviation move. So, what are the odds of it getting all the way up to 138? There's a 15% chance of it moving that high, which means there's still a chance. There's still a decent chance, actually, at 15% at 138. Yeah, I like this one. Let's make this the official paper trade. Well, and I see Kurt out there. Kurt popped in and said hello. Which one do you like better, Kurt? Do we go wider and spend a little bit more? Or do you think we do the $1 one? But there's options. There's options. We're going to lean bullish on this, of course. It's hard not to lean bullish in this marketplace. There's only a few stocks that I would lean bearish on. And actually, the one stock that we called out was Apple, only because it had such a good run up. And a lot of times usually you fade Apple if it has a strong move going into earnings. That's not a bad rule of thumb. Um, you like the one. Okay, Kurt likes the $1 one and maybe doing more than one contract. Okay. All right, we're gonna make. So, and if you do apples to apples, right, you would do two of the $1 ones, or you would do one of these, because you're spending if you're gonna say I'm gonna commit $200 to this trade, and that's Kurt's comment there. Okay. I like that it starts at 126 though. That's the only thing I'd like a little better. This one starts at 129, so it's got to get to 129 before the trade really becomes interesting. Uh, and here it starts right at 126. I think that's the thing I like the most about it. 180. So if we go from 129 to 134, we can make $4. That would be $8. We make 800. Well, we got more upside. Got more upside for sure on two contracts versus one. On here we got we can make 600. All right, I wanted to go with the 180, but I'm going to listen to the listeners here. One of our most our MVP attendee, I guess Kurt would be. Let's go in and let's. I'll do the short. We'll make that the official. We'll do the short one. We're gonna do the short one, and I'm only gonna do one contract here, but we'll do this trade. Let me send it to the ticket, and let's call this the official paper trade today. And if you want to do two, you do two on your own. As usual, we always say that this is not meant to be a recommendation, but recently I'd say 7 out of 10, and that's being realistic on the last this earnings season. This earnings season's been a good earnings season as far as most of these trades are concerned. Yeah, let's make it official. Let me set this up, and I will give you a read back. We're gonna do this. We're gonna do the $1 one. We haven't had a $1 trade around earnings in quite some time. So Cisco is trading at $123.22. It's up $1.79 on the day. The company is going to announce earnings this Wednesday after the close. We're going to look at the August 14th expiration, which is 4 days away. We're going to get bullish on Cisco by doing an open wing butterfly using calls. We're going to start by buying the 129 strike. We're going to sell 2 of the 134 strikes, and then we're going to stop short on our short spread of our butterfly and buy 1 of the 136 strike calls. The net debit for this entire gaggle of options is $1. Means our maximum risk is $1 if the market actually goes down or just stays the same. We have that risk. Anywhere from 129 on up, we can be profitable on this trade. Ideally, our target would be at right at the expected move of $134. And we're going to send this down to the trading floor. So boom goes the dynamite. Order has been sent. All right, let's go back and look at our portfolio. In Caterpillar, we did that in Fundamental Friday. Got a Netflix trade on here. And I think Netflix is one of the first in the Meg 7 to announce earnings. And I want to take this position and look at a SpaceX trade too. So SpaceX announced earnings. This position is down to, okay, so I want to do 2 positions. Netflix we did as part of Fundamental Friday. So I'm not going to mess with Netflix. Let's do the SpaceX trade. So I don't want the cheese anymore. Just let me out of the trap. That is the trade that I like in SpaceX. We've talked about this. We talked about hedges in SpaceX and everything. If you like the stock, here's the way to buy protection. We did a lot of that when the stock was all the way up at 180 or so. But now we finally get a little bit of strength. We had actually sold off after the earnings report. There are going to be a lot of things that are going to be happening in SpaceX. Holding periods, release of stock. Like there's a lot that's going to be happening over the next quarter, flat out. Not to mention the fact that they're still looking to get capex spending. They had this huge IPO, and then they came out and said that we're going to go to the bond market and actually raise some more capital. But at this moment, I am actually froze. We sent that trade to the floor. Kurt made an offer. We can do one, and I'll do the other, and we can compare and dissect afterwards. Thanks for that offer. Yeah, well, I did the $1 one. I sent it down to the floor. So there's our scenario. But I do need my computer to move, and it just decided to stop. So it's very hard to set up a trade when there you go, when you don't have option quotes. Option grid. Okay, SPCCX. There we go. August, we'll go out to September. So September's coming. We still got a VIX trade in our portfolio. Yes, we do. 17/21/22. August 19th. We got to keep that trade in mind. All right. So next show. So Wednesday, we're going to look at a VIX trade. We're going to look at a VIX trade. We're going to use a September expiration. And we're going to look at the VIX. We will also explore this trade right here. We got the VIX trading at $15. We're going to look at this trade. And it's time to do something with this position. Either we can close it out. There were times that it was profitable. We had a run up in the VIX. We hit the 21 level. I don't know exactly what happened with the August position, but we'll take a take a peek at this trade, and we'll review this on Wednesday, and we're going to set up a September expiration long VIX option trade. That's what I'm going to look to do on Wednesday after. Well, the Cisco trade won't have played out because Cisco is announcing earnings after the market on Wednesday. So let's take this trade. We'll we'll go on SpaceX. I'm going to set up what I like to call a covered call on steroids. I don't even know if we need to go out 25 days. Let's see where we're at on 18 days. 83 vol. And that's actually below the historical. Okay, so we should do pretty well. Now, what's important on this trade is that volatility gets higher as you go out. And that's not always the case where you get big skew from, we'll call the middle. 144 is at 85 vol, and then we go all the way up to 175, and we're still got some price in this. You want to make sure that it's a real option. It's trading for $1.90, and it's trading for 83 cents. So there's a big skew in volatility. Still a lot of people buying out of the money call options, and that is driving up the implied volatility on these out of the money call options. And you see the high open interest on a few of these strikes, even looking at the August 18th expiration. Now, we might do the September 4th, but let me start by looking at the August 18th. Now, I want to emphasize that we have 100 shares of stock. We're going to do a ratio spread. It's an alternative to a covered call, so it's not that fancy of a strategy. But we're going to put this position on where we're going to buy one option contract and then sell two option contracts to pay for it. Now, if we do that, ideally you would be naked an option. You'd be naked that second call option. But remember, we have 100 shares in our portfolio, right? We had 100 shares. There it is, right there. And so that second call is actually covered by the stock. This means that in a range, we're going to be like owning SpaceX on margin. And it's not going to cost us anything. And the reason why we can do this is because of this implied volatility skew. It doesn't work out well on a quote unquote normal stock that doesn't have this where you're going to be selling further out of the money options at higher implied volatilities. Okay, so I like that one. That's the 140, but that's a little bit tight. Maybe we'll go 140, 145. Let's see if that works. 140 is at 82. 145 is at 84. 145 is selling for 6. We can go even further. All right, so let's do 140. Man, there's this, it's just the premium is sticky. Like you just look at these strikes. This is 30 cents more than this one. This is only 30 cents more than that. Like there's just a lot of juice in all these option contracts because the vol is so high. Let's 620 times 2 is 1240. Man, that's a lot of premium. And we're not going to have to go out to September, that's for sure. We can even look at the 550. Well, let's do it. All right, here we go. This I'm surprised. I've been surprised by this. I've done quite a few of these. I've talked about a few of these. I actually had one in on a portfolio because I owned 100 shares of SpaceX, and I luckily got out when the stocks started dropping precipitously. But this trade is just a real interesting trade. If you're looking to do SpaceX, if you own 100 shares and you don't want the cheese anymore, just get me out of the trap. I wrote it all the way down from, let's say, 160 or 150 at this point in time. And you're like, I just really want to try to leverage options to try to get most of my money back. I'm going to try to go 10 points wide. That'll bring in an extra 10 points from 140 to 150. Yeah, that's crazy to me. Now, you guys, I'll show you what I'm talking about. I'm doing the math in my head here. $2.40 net credit to the account. So if I just sold the 150 outright, I could bring in $5.45. If I just sold that, that's nothing to sneeze at. That's a good amount of premium. If I do it this way, I cut that premium in half. I'm going to bring in $2.40 on the midpoint. A little bit less than cut in half. I'll be realistic, right? So it's $2.40. But I'm going to have an extra call option. So anywhere above 140, I'm going to make out on this call option. And if it goes all the way to 150 by that August 28th expiration, I'm going to get an extra 10 points, an extra $1,000. So, where is the bad in this strategy? If the stock market went down, I'm not going to bring in as much of a credit. My pillow to protect myself on the downside is going to be a little bit thinner. Might have a little neck problem afterwards, right? As opposed to a nice big fluffy pillow, which would be $5.25. So I really like this trade here. Now it moved. I like the 240, but you got to really work this. You got to work this trade a lot. So if I'm putting it in there, I'm going to work and tweak it a nickel. I would keep it at 240, but I'm going to adjust it for the show because I want to get it filled before the end of the call. So let's go. I'll go 210 on mine, but I like the 240. Okay, and now let me send this to the what if calculator. And I'm going to show you the difference between just the option strategy. And in the options playbook, if you go to optionsplaybook.com, this is called a front spread. 1x2, or it's also referred to as a volatility ratio spread. It's just a ratio spread too. 1x2. It's 1x2 for a net. It's a butterfly without the third wing, right? So if we're doing this, this looks risky as heck. You got small profitability on the way down, and then if it continues on up, this is a trade I do not want to do in SpaceX because of the risk. You have unlimited risk because you are short one extra call. Now, all I'm going to do here is add equity. I'm going to add 100 shares of stock, which is already in the account. And then this profit and loss graph changes dramatically. Boom. Looks like a covered call. But hey, wait a minute. Look from here to here. The rise over run is 1 to 2. So for every point movement on the way up, I make 2 on this position. Why? Because I'm long this call at 140. And it doesn't have to get to 150 to be profitable. If it goes to 145, I still make an extra $5 from 140 to 145 on the trade. And you can, and if you have 200 shares, you can just sell the long call. But in this instance, you're going to probably close out the entire trade. But what I have done before with these is just remove the short option, especially when you're 10 points away. This option contract will decay a lot faster because it's way out of the money relative to the 140. So the stock goes to 145, you wait a little bit, you close this short option contract, and then you play that long option. I've done that before, but that's if you're very active with it. But it's a real interesting trade to add to a stock position, covered call on steroids. I'm not the only one that has ever called it that. I wouldn't put that in my book, but that's the trade. So let's execute this. Man, it's moving. So it's already. How come this always happens when we talk about a strategy? It just seems like everybody leans on the strategies as we're talking about them. I'm gonna send it down at $2. Let's do it at $2.10. So I'm going to go back to here. Okay, so the covered call on steroids on SpaceX stocks is at 133.74. It's up 63 cents on the day. Heading into the end of the week, last week it made a strong move to the upside. We're going to say we own 100 shares of SpaceX, which we do inside this account, inside that portfolio. And we're going to go out to that expiration and buy the 140 strike call and sell 2 of the 150 strike calls. We're going to work that order. I'm going to send it down at $2.10, but I'm going to make sure it executes before the end of the day. And that's $210 per 1x2 ratio spread that we're sending to the floor. So the total net credit, if this gets executed, is going to be $2.10 or $210. Boom goes the dynamite. Order has been sent. Yeah, and our other order has to get sent too. Okay, so there we are. That's it. Any other questions? Looking at I'm not liking the 52-week high at 130. Be a stretch. Okay, so Kurt, go ahead. And Kurt had a comment on the chart, and I didn't go directly to the chart. I knew we were going to be a little bit long on the show, and he's just highlighting a resistance area on the upside, and I agree with that. I saw it. 129 right there, but it also means that there's potential for the stock to run. We have, in our instance here, we got a little bit of a period of consolidation and a little bit of a move up, but we're sitting right here. I think we're just gonna, labor at this level, waiting to see, are we going to make that next step higher, or are we going to come back down and go back down to this range? So you would adjust. I wouldn't worry too much about the 129, Kurt. Kurt, go ahead and toss that one up. If that's all right if we don't. There it is. Okay. 130 is fine. You're still gonna if you're 1 point off. You're the fact that option contract doesn't get in the money that we sold, and we sold 2 of them. It's not that big of a deal. Time decay is going to happen really fast, and if it's a little bit out of the money, time decay would happen. I would stick with the 130. I don't have any concerns here with that whatsoever. Here's that range. So we come down to here. 140, yeah, 114. This was and it looks like it was a buy right there, but we could have filled the gap to the downside. I'm kind of, if you're looking at charting this, you would say, well, this is going to fill the gap, and we're going to come all the way down to 102. But that didn't happen, and it's poker, not chess, right? So you're not always going to be right. But with this instance, yeah, I don't mind Cisco going into this earnings report. I like a lot of things that are happening there. Very strong move, obviously, over the year, like a lot of the other stocks in this space, and I think earnings is a potential catalyst. All right, that's it for this edition of Options Guy TV. We will be back on Wednesday. We will look at this trade, and then I do want to set up a VIX trade. We always do, year in and year out. And myself and Lex are going to get together and actually do a longer show on the VIX. And Lex and I are going to have a conversation about it as we head into the 2 most volatile months of the marketplace, September and October. A lot of geopolitical concerns going on. The market is set up. Haven't really had a really strong, 10% pullback. I'm nervous that it could happen in September and October. I am still bullish the market longer term. Didn't have real good jobs numbers recently. The term stagflation has came up again. So there are some headwinds. There usually is. But September and October, they seem to peek their head out a little bit more than other months. All right, so that's what we're going to look at. My name's Brian Overby. We'll see you this Wednesday for the next edition of Options Guy TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.